Investing in real estate can be one way to accelerate your journey to financial freedom, and you don't have to be rich to do it either. Real estate investment trusts, or REITs, can make getting your foot in the market as affordable as a cup of coffee, and they can give access to some of the hottest trends moving markets today. So, in this episode, we'll hear from an industry veteran of over 25 years who's going to share his take on what's moving markets and how DIY investors can tap into those trends using REITs. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise, and joining us today is Dean Orrico. He's the president and CEO of Middlefield Capital, a longtime veteran of the real estate markets, particularly through REITs. Dean, thanks so much for joining us. We really appreciate having you here.
Thanks, Rob. Good to be here.
Tell us a little bit about your background. You've got this extensive experience in real estate. How did you get your start in this industry, and kind of what kicked off your interest in it?
I've been in the financial services industry since the early 90s, so showing my age a little bit. I joined Middlefield in the mid-90s, and when I joined Middlefield, which is an asset management firm, this is right around the time that the REITs really started to become its own investable universe in the Canadian market. So this was kind of the mid to late 90s. They really started becoming much more prolific in the US about 5 to 10 years earlier. So these were really the early days of the democratization of real estate, which is, as you alluded in your intro, making this sector available to retail investors. So you don't need to have multi-million dollars of investable capital to go out and buy a residential building. You can buy a share of a residential REIT. So this really spurred my interest in the sector because I've always been passionate about real estate, as well as here at Middlefield, because we're an equity income investor. And I think REITs are the single best equity income vehicle available in the market.
Wow, that's a really powerful statement. So take us through some of those, pros, those potential benefits of a REIT versus, investing in physical property. You touched on some of them, but kind of expand on that thought for us.
What are the advantages of the REIT structure? Well, number one, you can buy it in small increments, so you don't need a lot of capital. On a related point is that it's very liquid, so I can buy and sell units of a REIT any minute of every day that the market is open. Number three, you have this regulatory environment that governs the REITs, so make sure that they have full transparency, full audited statements. Management teams are really required to provide full disclosure to investors in terms of what's going on in their businesses. You've also got a board of trustees, which is the equivalent of a board of directors, but because REITs are trusts, you do have this board of trustees that oversees the management and the operation of the business. You also have regular levels of distributions. Virtually every REIT pays a distribution on a monthly basis. So for investors who are interested in income, they get that on a regular basis, and it also comes very tax efficiently. So roughly about 50% of the income that a REIT pays to investors is basically flowing through their capital cost allowance. So that comes to investors in the form of return of capital. So basically, they don't pay the tax on it when they receive the distribution. It reduces your cost base, and then it converts it into a capital gain when you actually sell your unit. So again, when you think of all of those attributes, I think the REIT structure really is very attractive. I think related to that is, these REITs, because they have this requirement to generate stable levels of cash flow that support stable and growing dividends over time, they're not as risky as some of the opportunities that you might find in the private real estate market, i.e. the REITs do very little development. So they're generally speaking more buyers and not builders of real estate. So as a result, from my perspective as an investor, I would say that's a less risky way to play the real estate market. and it gives me more comfort in the predictability of the revenue stream, which, as we know, is contractual in nature. People sign leases that are typically in a open air shopping center. I'm signing a 5 to 10 year lease, so the REIT knows when that income is coming in, how much that income is, and that gives them comfort in terms of determining what dividend to pay to investors. The negative, if you can call it that, is that because they're traded every day and you've got the effect of movements in interest rates and inflation that affect the business, really you will see the volatility in the trading price, where if I own a triplex, I don't go to it every day and say, okay, what's the value of it today? And the value goes up and down. So it's less liquid and you don't see the volatility in its asset price. So as a result, you do have this volatility in the public market in REITs that you don't necessarily have in the private market. But from my perspective as an investor in REITs, that creates an opportunity like I'm seeing in today's market.
Okay, well, so thanks for kind of giving us the lay of the land there. Yeah, REITs certainly a little bit complicated of a structure in some respects, but certainly like an interesting avenue for people to get exposure to real estate if that's what they want to do. So thanks for filling us in on that. And of course, now let's get into some of these hot real estate trends and what that means for investors if they are going to use REITs as one way to get access to it. But before we get into that, I just want to mention to our viewers, make sure you subscribe to TD Direct Investing on YouTube so you can catch future and past episodes of Inside Investing. We love to kind of hear what you have to say in the comments, and make sure to let us know too, like what you want to learn more about. We're always open to suggestions and making topics that really resonate with our audience. So keep those suggestions coming. Anyway, with that said, let's get into it, Dean, talking real estate trends here. And I think the logical place to start, it's certainly the space in real estate that most people, I would say, are most familiar with. That's residential. What's going on in residential markets that you think is really interesting today?
So great question, Rob. So let's talk about the residential market more broadly, and starting with single family housing. We know that in Canada, the price of single family homes is out of reach for a lot of people. So generally speaking, you've got 80% of Canadians living in urban centers. About 50% live in our 6 or 7 largest cities, what we call the VECTCOM plus Halifax: Vancouver, Edmonton, Calgary, Toronto, Ottawa, Montreal, and Halifax. So if you're on a plane and you're flying over Canada, you see all of this land and you say, well, why is it that everybody's just living in these major urban centers? Why aren't we utilizing this? And the reality is, there's not enough municipal services or infrastructure outside of these major centers. So as a result, this is where everyone's congregating. And then you think about places like Vancouver or even Toronto, where in Toronto we've got Lake Ontario at the southern end, and then the rest of the city is basically enveloped by the largest greenbelt in the developed world. So as a result, all the municipal services really reside within that envelope. And as a result, that's where everybody is living. So that's really driving up the price of residential real estate in those areas. And the same really goes for Vancouver. You got an ocean at one end, you got the mountains at the other. Everybody's in that enveloped area. So as a result, greater demand with limited supply pushes up prices. So from our perspective as investors, we are really very keen on the multi-residential sector, which is basically the apartment REITs. So you've got a number of REITs in Canada that own, don't do much development, but on a limited amount, you are seeing some development, but really buy and own apartment buildings. So on average, the rent today is about $1,500-$1,600 a month, but the market rate in some cases, Rob, can be close to $3,000 a month. So not surprising, the turnover, i.e. tenants vacating a unit, is a lot lower today than it was 5 years ago because rental rates have gone up. But there's tremendous opportunity in these apartment rental REITs, these multifamily residential REITs. So that's a sector that we really like. And again, it gets back to this point that you've got growing demand, limited amount of supply. House prices are out of reach for a lot of Canadians, especially younger people. So as a result, they're now starting to look at renting, and rental rates are going up because of that demand supply imbalance.
Yeah, I mean, certainly housing affordability and supply have been like really hot button issues. And without getting political or anything like that, we are seeing some push or at least talk to making housing more affordable. How would that change the dynamic for residential investing from an investor's perspective?
You're right. We're seeing government bodies, particularly at the federal level, really starting to address this issue. And the federal government, I think, has finally come around to the view that we need to incentivize supply, not cap rents, but incentivize supply. Because if you're capping the amount of rental revenue a REIT could earn, they're basically going to say, why build new properties? Or why buy new properties if I can't make the type of revenue required? So, for example, last year they introduced the elimination of HST on purpose-built rental buildings. So that's a very positive step. We still have a lot of municipal and development charges, which I think increase the taxes on building new buildings. A lot of developers say the total tax burden on building a new multi-unit residential building is somewhere about 30% of the total cost, which is high. So that's now being lessened somewhat by the reduction or the elimination of HST. That's a positive. They're putting more money into the CMHC, which is an arm of the federal government, providing lower cost financing to residential buildings. That's positive as well. But at the end of the day, Rob, I think we have to look at this, really very soberly and recognize that there is no easy solution to this. CMHC has estimated that the shortage in housing is anywhere between 3 to 4 million. People think it's probably closer to 5 million homes between now and 2030. So what we're saying is that just given the growth in population that we've seen and the pace at which we're building new homes, we're going to have this shortage, which basically means that prices and rents are going to be higher over time. And just to think about this, you're going to have to build somewhere around 500, 600,000 homes a year to eliminate that shortfall. In a good year, Rob, we're building somewhere between 200 and 250,000 homes a year. This year is actually less because of the higher cost of construction and the higher interest rates associated with financing a new development. So the reality is we're not going to be able to meet that shortfall for decades, forget about years.
One interesting headline that we've been seeing in the news more recently relates to a place like Toronto, where we're actually seeing a lot of condos sitting on the market. They're not selling, and the supply seems very high. And that kind of seems to not contradict, but kind of challenge kind of what you're saying about the attractiveness of residential real estate and supply constraints and stuff like that. What's going on there?
Yeah, again, something that's become quite topical in the past 4 or 5 months. And you're right, Toronto being the largest, most populous city in Canada, you're basically seeing the condo market effectively in depression right now. So to your point, what's happening? And you've got, again, the same issues. You've got condo developers effectively having pencils down because they can't pre-sell enough units to get financing to actually put up a new condo building. So why aren't they getting the pre-sales? Well, number one, their prices are higher. So why are their prices higher? Their prices are higher because their construction costs are higher. All the other charges. So yes, HST is eliminated, but generally speaking, you've got construction costs are higher and you've got higher costs of interest as well. So it's really difficult. It's not as economic to put up a condo building. So they don't want to lower their price because they're not going to earn the kind of return that they want. And as a result, investors who have to borrow, to buy a new condo unit, condo prices are somewhere around, $1,500 a foot right now in some developments. That's really making it very difficult for anybody coming into the market right now looking to buy a studio or a one-bedroom condominium. So what are the solutions? Well, one, we see interest rates coming down. I think that's going to help over time. But I think the major issue is construction costs. And based on a lot of discussions I've had with financiers at the big life companies who generally provide loans to new condo development, or When I'm talking to the banks as well, they're basically saying construction costs don't look like they're coming down in any significant way. So as a result, you're going to have this real demand supply imbalance probably, and unfortunately for an extended period.
And you mentioned interest rates there, and of course that's another hot button topic for anybody when it comes to real estate. Um, just in your view, where do you think that interest rates are headed in Canada, and kind of more specifically, what does that mean for investors who might hold residential properties through something like a REIT?
We've seen two cuts by the Bank of Canada on June 5th and July 24th. Um, and we think you'll probably see at least another two or three cuts over the next 4 to 6 months. So interest rates are moving in the right direction. That is lower. So that's certainly positive from the perspective of anyone who's looking to build residential real estate, or anyone who's looking to buy residential real estate, so consumers. And I think it's also a positive for REITs. When interest rates moved up, Rob, to this point where you can get a GIC, which is basically riskless, giving you 4, 5, 6% in some cases at the peak, a lot of investors say, well, we haven't seen GIC rates in a generation at that level. So they sold or didn't invest in REITs. They bought GICs. Now you're starting to see rates come down, and not surprising, the REIT market in Canada, just over the past month, as interest rates have started to come down, is up by about 10%. So you're seeing the immediate response by investors. And I think a lot of this cash that has basically been on the sidelines, sitting in GICs or other cash-like instruments that were yielding 4 and 5%, I think over the next 6 to 12 months, that'll start making its way into the market and going into REITs, which, as I alluded earlier, I think are as attractive as I've seen in terms of where they're trading relative to their long-term average, where they're trading relative to their current net asset value. It's attractive as I've seen in the last 10 plus years.
Wow, again, powerful statement. Interesting dynamics going on in these markets. So let's bring it home for a DIY investor. Let's say I'm on the hunt for a residential REIT of some sort. What are some of the factors, some of the features that I would want to be looking for that might make one more attractive to me than another?
So first and foremost, don't reach for yield. Don't get sucked in by a REIT that might be offering a higher yield, because that's usually, more often than not, telling you that's a much riskier vehicle. You need to focus on quality. You need to understand what's happening within that REIT, and things to focus on is what's happening with leases that are coming due, and are those leases being renewed, and are they being renewed at a higher level than the lease that was in place? What's happening with their balance sheet? Have they done a good job managing the debt level on their balance sheet? So as interest rates have gone up, the best quality REITs have been able to reduce their leverage, so to really minimize the higher interest cost burden on their business. And in particular, they've reduced their line of credit, which tends to have a higher rate of interest than the mortgages on their buildings. So again, you want to understand that. You want to understand how much liquidity they have in being able to take advantage of opportunities, because as a result of this higher rate environment, you've got a lot of private real estate developers who might have put up a new project, are now maybe more cash strapped. So a well-financed REIT could take advantage of those opportunities, especially if you've got good liquidity and access to capital. So I think you want to think about all those sectors. And then over and above that, you also want to have a sense for which one of these real estate sub areas do you think have the best fundamental or supply demand outlook.
And are there certain metrics that, if an investor runs a screener on their trading platform, or they dive into the financial statements of one REIT or another, are there specific metrics that they can look for, and specific levels that they should be looking for, in your opinion?
So the ones we focus on is that we look at, where the price is relative to, say, their funds from operation. The acronym there is FFO. So we look at where that is today versus where it's been longer term. I just did some work in the past week or so with my analysts where prior to the first interest rate hike in March of 2022, our portfolio of Canadian REITs, by and large, some US REITs, was trading at a price to FFO of about 18 times, and that was roughly in line with the historical average. Today, that's at about 14 times. So you can see that we're at a significant discount to where we were prior to rates going higher. So price to FFO is an important metric. Price to NAV. So, the REITs themselves publish what they believe their NAV is. We look at that and we say, okay, is that properly using, what the current capitalization rate is? And that's a difficult one as well, because the capitalization rate, which is basically the denominator in the calculation for NAV, the numerator is your net operating income. Capitalization rate is usually reflecting, what the current interest rate environment is, plus some type of premium. So the higher that denominator is, the lower your net asset value number gets. So is that capitalization rate properly reflecting what's going on in the market? That can be a challenge because you really only know by virtue of transactions in the market. And the transaction activity up until fairly recently has been relatively muted. You've got potential buyers not wanting to pay up because they know interest rates have gone higher. You've got potential sellers who maybe aren't in distress, not wanting to reduce their price either. So you've got this lack of transaction activity, which then makes identifying a proper cap rate more difficult. But again, NAV, if you're doing your homework, that's something you should certainly look at, properly using what you think are the proper numbers in the market. And I would also say, look at the quality and the track record of the management team. It is so important to understand who these management teams are, what their track record's been, how they're looking at their business going forward. Are they looking at really reshaping the portfolio? Are they looking at selling old assets and recycling that into new assets? All of these things are really important when you're trying to understand whether a REIT represents good value in today's market.
Awesome. We appreciate those tidbits of wisdom there that we can put our finger on and look things up like that in our screener tools or in financial statements and stuff like that. It really makes it really practical for our audience. So appreciate you sharing some of those. Let's switch gears here to another trend in real estate, and this one around office real estate. And there's been a lot of headlines about office real estate as of late here. So take us through, what are some of the major trends moving office real estate these days?
Sure. Now, that by and large has probably been the hottest topic, really since the pandemic. The office market continues to have a number of headwinds. So when I think about the US market and the Canadian market, generally speaking, you've got this continued work from home phenomena, which tends to be highest in North America versus, Europe or Asian countries. People here still are working from home more than they are in some of those other economies. So that's a problem. So as a result, corporations are saying, I don't need the same type of footprint that I had pre-pandemic. So the demand is less. And in areas like Toronto, you've had that reduction in demand at the same time supply is coming on. So that's created a bit of a perfect storm. So as a result, in the GTA, the largest office market in Canada, you've now got vacancy rates, roughly 20% or so, 20 to 22%, and probably going higher before they start coming down. So, Rob, that's creating a challenge for anybody who owns office properties. And when you look below the surface, there's really a bifurcation going on. The newer office buildings, the ones with great amenities surrounding them, the ones with, better light, better air, i.e., buildings that have really been built over the last 3, 4, 5 years, are the ones that are 90% plus occupied or leased. They may not be fully occupied, but they're 90% plus leased. On the other hand, the buildings that have been around for 30, 40, 50 years, which have smaller windows, have poor air quality, may not be surrounded by great amenities like the newer buildings are, those are the ones that are sitting at 40 and 50% vacancy. And that's going to be the challenge. And I think, and some REIT CEOs have basically said, a lot of those buildings are really obsolete. So we're going to have to find another purpose for them. Much easier said than done. For a number of them, the long-term strategy probably is knocking down that building and putting up an apartment building. But in places like Toronto, there are bylaws which make that very difficult today. So there's going to have to be some changes to that. So I would say the office market still has some challenges, and I would still be very cautious when looking at some of the office REITs.
Now, obviously, one of the golden rules of investing here is buy low, sell high, and we've certainly seen, to your point, some of these office properties, older ones in particular, as you mentioned, take a hit on their valuation. Is this a good buying opportunity in your opinion, or is there another shoe to drop that has to happen before we get to that point?
So I get asked this question a lot. Some of these office REITs have really been knocked down. They're down 40, 50, 60% from their highs. So on the surface, you say, well, that looks like great value. And my caution to investors is that that's often a value trap. In most cases, you're best off selling that stock that's gone down, whether that's an apartment REIT or any vehicle, and moving on to something else. Because I think the road to recovery is likely going to be very volatile and very long. So I would be very, very cautious about trying to pick away at some of these office REITs that have been really beaten down, that are publishing net asset values that are, 3 times their current trading price. Even if some deep-pocketed big institution like a Blackstone, it's unlikely that they're going to be looking at those sectors. We're getting no indication from the Blackstones or the Brookfields of the world that they're looking to increase the amount of office exposure in their portfolio. So I'd be, as I say, very cautious about that.
Okay, and you sort of touched on a few of those other little sectors that maybe are a little bit more niche, but can offer some pretty compelling opportunities, in your opinion. Can you tell us a little bit more about a couple of those?
I've been really leaning into the seniors housing sector for the past 12 months or so. I've known these businesses for a long time, really since they IPO'd. By and large, they're all doing really well right now. As we know, we've got an aging population. You had the senior living space hit very hard, probably harder than any other sector during the pandemic. So you've seen since then, really over the last 2 years, just a gradual and regular increase in occupancy. You've also seen a lot of the costs that they incurred during the pandemic come down significantly. Cash flows dropping to the bottom line, and you're seeing returns this year in that sector between 20 and 40%. They've done that well, and you're seeing the same thing in the U.S. So that's an area that I think is really attractive, and I think you still have more runway. And in our portfolios, we go to the U.S. market for areas that we really can't get exposure to in Canada. And in particular, that would be things like data center REITs. We like the data center sector because you really have this growth in this digital transformation that's been happening in our economy and really all over the world over the last 10 years. And that's just growing. In fact, it's growing exponentially as a result of this investment in AI. So Microsoft and Amazon and Oracle, they're basically making huge investments in AI, and basically they're what they call the hyperscalers, and basically building out their data centers because AI requires much more data storage. And that's basically what the data centers do. So that, I think, is a real growth area. Related to that, you would have the cell towers. Again, more in the US market. You don't have cell towers that trade as REITs up here, but you do have those in the US. And again, just given the growth in data, there's more demand for cell towers to transmit the data, and they pay very regular and I think over time growing levels of distribution. And I think they're also trading attractively today. So those are some of the more nuanced areas of the REIT market that we really like. There are others, but those are our favorites right now.
And because those are more niche segments of the market, are there any particular metrics that an investor might want to consider when they're evaluating these opportunities?
Well, they're very different businesses. So for example, in seniors housing, if you just take a step back and think about what that business is, it's very different than owning an industrial building where you sign up a tenant to a 10-year lease. And the industrial building is a fairly simple business compare that, Rob, to running a senior's home where you're basically responsible for the full right-hand side of the financial statement, i.e. the P&L. You're hiring staff, you're delivering meals, you're delivering healthcare products and services to these people. That's a much more complicated business. So I think you want to understand that. And again, it gets back to the quality of the management team. This management team have a good track record and shown an ability to manage those costs and increase the rental revenue. And I think if you get your handle on those things, I think you can have a better idea of which ones you want to buy or which ones you don't want to buy.
Dean, thanks again so much for joining us. We really appreciate the perspective that you've shared on the real estate markets today. And to those in our audience, thank you too for joining in. And also make sure that you check out the full lineup of educational resources that we have for you, both in the Learning Center on Webroker and on TD's YouTube page. We hope to see you next time. Hope you enjoyed this conversation. Until then, bye for now. Have more questions? Then check out the links to the right and in the description below.